On February 24th, the Ohio State University Extension Beef Team hosted the 2021 Ohio Cattle Feeding School via Zoom. With the recent volatility in fed and feeder cattle markets, risk management for livestock producers is of increasing importance. Knowing that, the first portion of the cattle feeding school focused on utilizing risk management protection, or LRP, and livestock gross margin, also known as LGM insurance, as tools to manage price and risk income. Listen in as OSU Extension Beef Field Specialist Garth Ruff introduces Erin Horst and Justin White of Hudson Crop Insurance as they discuss utilizing LRP and LGM products to manage the price risk cattlemen find themselves exposed to.
Well, good evening. I've got 6 o'clock. We're going to go ahead and get started with tonight's program, our 2021 virtual cattle feeding school. As we talk about livestock risk protection insurance, a couple of different programs. With us this evening are Erin Horst, insurance agent from Western Ohio, and then Justin White of Hudson Crop Insurance. He's joining us from Texas. So Erin, I'll go ahead and turn it over to you.
Thanks, Garth. My name is Erin Horst. I have been into the crop insurance business for almost 11 years now. And a part of the crop insurance portion is a livestock risk protection, or LRP, is a lot of the acronyms that we use. And it is a product that will go over, that will not cover mortality. It is not going to insure your freezer beef products that you're selling from your home, but more of those who are feeding out and selling groups of cattle. I work with Premier Crop Insurance. That's the insurance agency we work with. Hudson Crop Insurance is one of our insurance providers that we write with, and Justin is going to provide all the background on this product, and I can be a point of contact. My information will be at the end of the slides. So I am in Ohio. I'm licensed to write in Ohio and in Indiana. So I service customers up in Northwest Ohio and back in my home around Southeast Ohio, as well as Western Ohio. So we have insurance agents across the Midwest that we can put you with if you're not just here in Ohio and Indiana. So Justin, let you go ahead and take it away.
All right. Thanks, everybody. So my name is Justin White. I'm with Hudson Crop Insurance. We are the one of the appointed providers to provide livestock insurance across the country. And as Erin said, we partnered with them to bring you tonight's information. We're going to talk about the LRP product, the Livestock Risk Protection, like Erin said, and then there's a secondary program that's offered through the RMA, which is the Risk Management Agency, the arm that manages the crop insurance program as part of the USDA. That other product is called Livestock Gross Margin, or LGM. And so we're going to kind of briefly cover that one, but really go into some of the nuts and bolts of the LRP product and how it may be beneficial to those that are cow-calf or stocker operations, and then potentially those that are finishing cattle off or something like that, because this product can be used for both. And LGM, that one is targeted more towards your feed yards or those that are producing the fat cattle. So just go right into the presentation here. So LRP, Livestock Risk Protection, it is an insurance product that insures against declining market prices. The market prices are the CME futures, so off the board, and the coverage prices that a producer selects is based off of those board prices. The coverage price is selected by the producer. So as a producer, you know where your break even is or where you want to set your price floor, and that's selected by the producer. It's a single peril price risk protection. So as Erin said, it doesn't cover any other peril. So no mortality, death, or disease losses would be covered. This is strictly just price protection. If any of you are familiar with options and futures, puts and calls, it's very similar to a producer that purchases a put option on the futures market where you select that coverage price and it acts like your strike price on your put option. Some of the attractive attributes for LRP policies to producers versus maybe hedging on the board, flexible contract sizes, so there's no minimum head that can be that needs to be insured or anything like that. I mean, quite literally insure one head if you wanted to, so no contract limitations. The flexibility to incrementally cover a few head at a time. So this product is offered every day that the board is open, and offers are made available by the RMA. So a producer could have his herd and break it out into different layers of protection, if you will, based on the different prices that come out daily. LLCs and endorsements can be tailored to fit producers of different sizes. Like I said, there's no minimum. There are maximum head limits for a crop year, which runs from July 1st to June 30th. So there are maximums, but there's no minimums. And so it really allows coverage for those smaller cattle operations where they're looking to maybe lock in some prices for 50, 25 head of fat cattle or something like that. Since this is a USDA program, there is subsidized premium. So as long as a producer you are conservation compliant with your local FSA office, you would qualify for the premium subsidy, where the government will pay a percentage of your premium. Another attractive point I'd like to make is the guaranteed price. So once you bind coverage, the prices are set. Premium won't increase. It won't decrease either, but it won't increase based on what the market does or what your cattle are doing or anything like that. So you have the guaranteed pricing mechanism in there that you already know what your costs are, and it's kind of fixed. And for those that may have operating loans or something like that, insurance has that flexibility where we can do assignment of indemnities. So a lender may look more favorably if you have insurance on your herd, if you're trying to get a loan or something like that, versus the future options contracts, which are a little bit riskier.
Justin, I wanted to touch on something you mentioned about the subsidized premium as long as you're signed up at the FSA office. Yep. If you carry crop insurance, you probably already have on file what's called the AD 1026. It's about highly erodible land. So if that is filed, you're already going to be signed up for the subsidy to receive subsidy on your insurance. So if you don't carry crop insurance and you would do the livestock risk protection, you may want to get with the FSA office and fill out that paperwork to make sure you maximize the subsidy.
Yeah, that's a great point, Erin. Those that are already signed up, you don't have to go recertify or anything like that. And as you know, that certification is good. You don't have to go every year. And so the same rules with that apply to the livestock products as well. So that's a great point. Just kind of doing some comparison. So you have your traditional basis, which is your cash minus your futures. LRP basis, what LRP does is it sort of reduces that traditional risk where you're not going to look at your local cash versus the futures. This is based on the cash price index that it's indemnified against. So it kind of takes out some of that local basis risk that you may have locally, since we're going to base it on coverage prices on the futures and settle it on a national cash price index. Where is LRP available? Well, due to some recent changes in the last couple of years, it's available everywhere. So all 50 states and all counties. So in Ohio, Indiana, the Midwest, that LRP is definitely an option available to you. When can I buy this product? So I think I said that it's available every day. So for LRP fed cattle or fats, and then feeder cattle and swine, sales open daily when the data is available on the RMA website. That's approximately around 4:30 Eastern, 3:30 Central. And then it's available until sales closing, which is at 10 a.m. Eastern, 9 a.m. Central the following calendar day. So for offers that came out this afternoon at around 4 o'clock-ish, that sales window will close tomorrow morning at 9 o'clock. On Friday, since it's the next calendar day, the sales period would only last until Saturday morning. So you'd have to make those decisions on the prices, overnight and into that next morning. If offers are not available on the RMA website by that 4:30 or 5:30 Eastern cutoff, that's kind of when everything kind of shuts down. If there's no offers out there on the RMA website, basically what RMA is telling us as the insurance provider and then you as the producers that there won't be any sales for that effective date. So we wait until that point in time if we don't have offers. If we get past that point, it's pretty safe to assume that barring any kind of technological error or something like that, system error, then there won't be any offers for that effective date. So what does it take to get signed up for LRP? So first of all, as a producer, you would want to fill out an LRP application. This is a one-time application that is continuous after accepted. Only the person with ownership of the insured livestock is eligible for the coverage, so they must have an insurable share in the livestock. The application should be complete, and part of the regulations surrounding the crop insurance program, we have to include the Privacy Act and certification statements, as well as a non-discrimination statement, which basically just is saying that this program is available to everyone, irregardless. But that one-time application, once you've put that in, Erin, she would submit that to the insurance provider. She'd help you fill that out with all of your entity information or producer information, what classes of livestock you're looking to insure. And once that's been put in and processed, we'll go through and verify that you have your conservation compliance requirements met. So you would receive subsidy if you choose to bind coverage. And there's some other processing steps in there, but that one-time application would be good for each crop year until canceled by the producer at every point in time. But filling out the application has no cost to it. And then just filling out the application does not bind you to any coverage or anything. It's only setting you as the producer up to prepare you where you can bind coverage.
It's very important that whoever is the owner, if you're a spousal, if you're married and you're selling it as working as a husband-wife operation, but only the husband is retaining the ownership in the cattle, we still have to list the wife on the application. It's very important that we get all the correct social security numbers, addresses, or if you're an LLC, an EIN, all those types of identifications are very important on the application to make sure that is bound correctly.
Absolutely. Thanks, Erin. Those are good reminders. So just to kind of give you an idea of what the application might look like, this is the Hudson application. They're fairly all similar across because this is a federal program. As an applicant insured, you would your information here at the top, the entity information, like Erin said, if it's spousal, the agency information. So if you were to write with Erin, she'd be your crop insurance, your livestock agent, her information here. And here's where I was talking about, you select your classes of livestock that you want to be insured. So your feeder cattle, which is anything under 900 pounds, your fat cattle, and all those types underneath that. So steers and heifers, are all grouped together with fats, with feeder. We break them out into the different genders and to the different weight classes. And I have some more slides on that, but essentially this is just that initial application that sets the stage and makes you liable, but doesn't obligate you to buy an endorsement or buy coverage at any point in time. It just makes you eligible. So I said the word endorsements a couple of times. They're called specific coverage endorsements. And so that's actually what you would be purchased to bind coverage. That is what establishes liability. A producer may have multiple SCEs throughout the reinsurance year or throughout the crop year. So there's no limit to the number of SCEs that a producer can write throughout the year, but there are limits on the number of head that can be written per year and per endorsement. But essentially, you could write an infinite number of endorsements for the crop year. They can be purchased on the same day for different endorsement links, and you can purchase them at different times of the year. So if you had fall calves and spring calves, different things like that, a producer may have SCs for different classes. So they may do a fat cattle endorsement, but then also insure some heifer calves and some steer calves, and all those would be on separate endorsements. They'd all have separate liabilities on them, separate coverage prices, but they could all be written basically on the same date and locking in coverage. So what is the definition of fed cattle for the LRP program? It's all steers and heifers that are expected to grade select or higher with a yield grade of 1 to 3. They will be marketed for slaughter at 1,000 to 1,400 pounds at the end of the insurance period. All these weights are on a live weight basis, so this isn't on lean weight. These are the target weights that is set up in the policy. If your end weight is heavier than that, or if they don't make weight, there is no alteration to the endorsement or to the coverage. What was bound at the beginning of the endorsement period is what's insured on. And so if they go over or if they fall under what the target weight insured was, we won't change the coverage or anything like that. And we can't insure them over 1,400. That's how the policy is written from RMA. So if you do take them even heavier than 14, you would just want to target that heaviest weight at 1,400 pounds to get the most benefit, to closely match what your operation does. As of September 14th, 2020, the RMA made some changes to the program. One of them was they raised the maximum number of head that can be insured for the crop year and per that specific coverage endorsement I mentioned, that SCE. So that number was increased to 6,000 head, and the annual limit, which remember the crop year runs from July 1st to June 30th, that number can be up to 12,000 head per year. Endorsement links, so you buy an endorsement and it lasts for a certain number of weeks, and that's how long you have coverage for, and once it expires, then coverage ends. So an endorsement length can start out at 13 weeks or 3 months and go incrementally up a month all the way out and insure as far out as a year from the date you buy the endorsement, so as far as 52 weeks out. For feeder cattle, they have these broken into classes, kind of like I showed you on the application. Feeder cattle, they break them out into steers and heifers, the predominantly Brahma, the predominantly dairy, and new for what went into effect in January is you can insure your unborn steers and heifers, so what's expected. These have 2 different weight classes. Except for unborn steers and heifers, they only have 1 weight class. But if you have your feeder steers and your feeder heifers, they can be insured in a weight class of less than 600 pounds. So 600 would be the maximum target weight, or between 600 and 900 pounds. The same for the Brahma and the dairy. And then if they're unborn, the weight class they have established for that is anything up to 600 pounds. So kind of here's a little better breakdown of it in kind of a category. So you have your steer feeder cattle categorized in 2 weight ranges of less than 600 pounds, built, designed mostly for your steers and your bull calves, and then 600 to 900 pounds is steers only. Heifer feeders, the 2 weight ranges of less than 600 and then from 600 to 900. The Brahma are in the weight ranges of less than 600, and that's going to be for all. So that's heifer, steers, and bulls. And then the heavier weight, 6 to 9 steers and heifers. The predominantly dairy feeders would be less than 600, and that's all genders, so heifers, steers, and bulls. The 600 to 900 would be all heifers and steers. And then your unborn, because we don't know what they are, if they would just be clumped together, steers and heifers as one group. If they are coming from a predominantly Brahma herd or a predominantly dairy herd, then they would be insured that way. But there's only the 1 weight class, which is the target weight is up to 600 pounds. Feeder cattle have the same head limits and endorsement links as the fat. So anything from 3 months or 13 weeks to 26, 6 months, or as far out as a year, 52 weeks. And then once again, and this would be a separate head count than the fat. We wouldn't count the 2 together. So this one, you could do 6,000 feeders under 1 endorsement. And then for the effective crop year, you would get up to 12,000 head maximum. I mentioned that this is a subsidized program. Several years ago when I started in it, it was not highly subsidized and only 1 subsidy level was available. And so RMA has definitely seen the need for livestock producers to have effective risk management options. And so they've really started looking at the program in ways, how can we make this more attractive, more affordable, more viable for those producers to bring into their operation and utilize. So as you can see here, the subsidy factors were raised as of September the 14th. So these are the new effective subsidy percentages. And they're all based on the coverage level. So every day that, if you were to buy an endorsement, you buy that coverage price, that's going to be at a coverage level of an expected price. And so if you buy something that's between 95 and 100%, and that's your coverage level, they're going to subsidize 35% of the premium. As you drop down the coverage level scale, the subsidy goes up. Think of it as retained risk as the producer. Now you're retaining more of the risk because you're insuring a lower coverage level, a lower coverage price. So then they're going to incentivize that by paying more of the premium. This was effective as of July 1st, but since they didn't make it the rule until September, the note there just says we made it retroactive back to July 1st of 2020. But for going forward, everything now has these new subsidy factors on them. The next few slides, I figured just walk through some examples, kind of give you some ideas of how an endorsement, how a policy might work. So in this instance, we've gone through the application, we've got everything, we set the stage to where now you can bind those specific coverage endorsements that actually bind liability, give you that coverage price, give you that price protection that you're looking for. So start with a feeder cattle example, an operation that has 100 head of steers. They're looking to market them at about 850 pounds. Insured share, that just goes into our calculation. In this instance, it's a producer that he owns 100% of their livestock. We chose an effective date of 10/1 of 20, so last fall. And we took it out 17 weeks or 4 months with an end date of January 28th, 2021. So it just ended last month. And on that date, on 10/1 of 20, the expected ending price that was given to us by the RMA was 139.55. Now that number was based and was a derivative of the futures for that day. So that base came off of what the board was doing, and it does move with the board. So on days that it moves down, then you'll see your expected ending prices move down with it. And then the inverse, when they move up, your expected ending prices will move up. So on this day, they priced January out to where it would have an expected ending price of 139.55. Now here's where we'll talk about that coverage level, and this is how we'll determine subsidy. So then the producer selects a coverage price, which is a percentage of that established expected ending value that's published by the RMA. So in this instance, the producer chose a 98.89% of the RMA's expected ending value. So that price equals the 138. So that's going to be our strike price. That's our coverage level. The premium rate given to us on that day, and every day premiums change. They change with the offers that are given to us daily. On that day, it was 4.0145%. And then so we take and we look at our 9.89% coverage level based on that table I showed you earlier. That's at the highest spectrum of the coverage level, so they get a 35% subsidy. Do some quick math. We'll take our 100 head times our 8.5 hundredweight. Everything is calculated out by hundredweight, but 850 pounds steer, that's our target, times our coverage price of the 138 times the 100% share. You see there the insured has insured value of 117,300. Our value times that rate we were given when we kind of set up the example equals total premium, so gross premium, and it's always rounded to $4,709. We'll take and we'll subtract out our subsidy, so we know that that's 35%. So 4709 times the 35%, rounded subsidy equals 1648. 4709 minus the subsidy, we have producer premium. This is what you as a producer would have to pay for this coverage, would be $3,061. Breaking that down to on a per head basis for 100 head would be $30.61 or $3.60 per hundredweight.
On premium, in the past on LRP policy, that premium was due up front when you took that policy out. Now they have changed it. That premium, that $3,061, is not due until the end of that insurance period.
Yeah, absolutely. Yeah, that's another thing to remember. There's no cash up front to pay for the coverage. It is billable at the end of the insurance period. So if you break that 360 down per hundredweight, you're effectively paying a little less than 4 cents per pound for this coverage. So we've gone through the 17 weeks. It's now January 28th. And now we have that national cash index that I kind of talked about that the insurance settles against. And so what happens if that ending value that's published by the RMA comes out at 140.22? Well, since our actual ending value is greater than our coverage price that was established at 138, there's no indemnity due. This would be comparative to you buying that put option with that strike price and it never hit, so it expired worthless. Part of the process with that is Hudson would send out a letter that's indicating, hey, we received the ending values from RMA. Here's what it was compared to what you locked in. It was higher, so there's no indemnity due at this point, or there's no claim payable. This ending value is not based off of the local market. So, no, we wouldn't look at your receipts to say, what did you get at your local barn or anything like that. And the other thing to remember is that a producer still gets to capture all the upside. So, if you get into a loss situation, or you get into the situation and maybe your prices were higher, then you still get to capture all that upside. None of that gets taken away. You're basically just buying, you're basically just locking in coverage off of the board and then looking at that cash index. And if it falls below, then it indemnifies you, pays you a claim for that loss. So an indemnity is payable when the actual ending price is less than the coverage price. So let's kind of look at what that might look like. So the producer selected the 138, and this is a live example. So this is actually how it would have acted. So on 128, the CME feeder cattle cash settled index was 136.02. So that's the price that would be the actual ending value for this endorsement. And so when you look at 136.02, it's less than your 138. So instantly we know there's a potential loss there. So kind of calculating that out, if you took your 100 head times your target weight, you get total 100 weight of 850. Subtract your coverage from your actual to get the difference per 100 weight. That was a loss of $1.98 per 100 pounds. So the 850 times 198, we have an indemnity of $1,683. That shared, this is where it calculates back in. He owned 100% share in his herd at that time. So we have a loss of the $1,683. Kind of divide that out. We know it's $1.98 per 100 weight or $1,683 per head. Wanted to illustrate what this endorsement kind of looked like over time. So we start back here on 10/1. We set our coverage price, which is the blue line, at 138. Our actual price that day was actually up here over 142. And as we progress through the 17 weeks, we see what the cash market did, and it fell. And the blue bars here indicate where the loss was. So once we break below the blue line, we have a loss. It briefly went over our coverage price at the beginning of December. So loss went to 0. It dipped again mid-December. Then through the rest of December, we were slightly above our coverage, but then it fell again. And then right before it ended, we had a slight rebound in the cash price. So then our indemnity settled right here, that difference between the blue line and the gray. And that's what we were covering. Not taking into account anything you got at your local barn, your local operation, your prices, anything like that. This is strictly between that coverage price and that cash index.
And if there is a claim, you do not have to have an adjuster come out, survey your cattle, survey your scale tickets, etc. It's not like crop insurance. This is will automatically send you a claim if there is one.
Absolutely, yeah, yes. Since it's just price insurance, there's no, there's no claim process to go through, or adjustment process to go through, I should say, where we have to look at the cattle and everything, because we were just looking at the prices. So that's a good point, Erin. Thank you. Want to take you through a fed cattle or fat cattle example, just to kind of show you maybe some of the little differences. All the calculations, the policy standard across the board, the calculations are all the same, but just kind of looking at different weights and the different types. So in this one, I chose 50 head of fed. The producer's looking to market them when he's going to send them off for slaughter at 1,300 pounds, 100 weight. So that'd be 1,300 pounds. Insured share at 100%. On this one, we're looking at an effective date of 1/31 of 2020, and then an endorsement length of 13 weeks, which was May 1st of 2020. So this was last year, kind of pre-pandemic and after pandemic, just kind of show you really how this can really help if we find ourselves in any sort of situations like that again, and really how the idea of the product's supposed to work. It really is an insurance product. And there to protect you, kind of those disaster type situations. On that day, on January 31st of last year, the expected price, which fed cattle is based off of the live cattle contract, feeder cattle is based off the feeder cattle contract on the board. So live cattle were somewhere around 118.91. So that's our expected ending price. And then remember how we took and we established a percentage of that. So on this date, on January 31st, we took 98.68% of that RMA expected ending price. And so that gave us a coverage price of 117.34 per hundredweight. On that date, the premium rate for this coverage was 3.3816%. Because I wanted to stay true to the example, what would have happened last year, given the circumstances we were in, at that point, the subsidy had not been raised. So prior to July 1st of last year, the subsidy rate for this coverage would have been 20%. So if you think about it, just between last year and now, they've really tried to incentivize producers to look at this as an option that they could really use. So here, the premium subsidy is not going to be as great. So just keep that in mind that going forward now it is higher, but I wanted to give you a true example of how this policy could have worked for your operation had you known about it or had purchased one. So to do the calculation, 50 head of fat cattle times the 1,300 weight times our coverage of 117.34 times 100% share, we get 76,271 as our insured value. Times that by our rate that was given to us by the RMA on that day, we have total premium that's rounded to $25.79. Take that times our 20% subsidy that was effective last year times 20% is $515.80. So round that to $516. So we take our $25.79 minus the $516 subsidy. We have a producer premium of $2,063. And then divide that out by our 50 head. So our per head premium would be $41.26 or $317 per hundredweight. If you were to write the same endorsement back on January 31st of 2021 with the new subsidy at 35%, something like this, the subsidy would have been around $903 because you'd have got the 35% subsidy, and the producer premium would have been reduced down to about $1,600. So me saying that, you can see that raising that subsidy level really does make this a better product for guys that really are just looking for that break-even protection, or just that worst case scenario protection if the bottom fell out of the market or something. So what would have happened if it was higher than the 117.34? So I put in 118.73. Once again, there's no loss there. The process, the actual ending value given to us by RMA is higher than the 117. So this one basically is expiring worthless, like in the previous example. So what happened if it's less? So in our case, we had a coverage price of the 117.34. On this date last year for the 5/4 report, which it ended on May 1st, I believe, the ending price on that day was 102.63. This price isn't from it's not a national cash index like the feeder cattle that's provided by the CME. This is from an AMS, the Agricultural Marketing Service arm of the USDA. And they have a weekly report that comes out. It's called the AMS 5-Area Weekly Weighted Average Direct Slaughter Cattle Report. It comes out every Monday, and it's for the preceding week. So in this example, the report came out on Monday 5/4, and remember ours ended on 5/1, so we got that price that was reported on 5/4. On this day, the ending price was reported in at 102.63. So if we do our math on this one, we have 50 head at the 1,300 pounds times 650 was our total weight. We kind of minus out our coverage from our actual ending value, 117.34 minus the 102.63. We have a $14.71 loss per 100 pounds. So our indemnity there is $9,561.50. And then break that down to per head, that's $191.23 per head. So if we kind of look at what this did over time, what I did is I took the weekly report that came out. And so our blue line we set up as our 117.34. And then our gray line is our weekly AMS reported prices and what that did over time between last year. Remember, into February into March, we went into the pandemic, and then what the live cattle, the finishing cattle did, and when it ended in May. So you can see there, it just kind of progressively slid down. We had a brief rise there in late March, and then it continued to go down through April and May. So just to kind of show you where what the feeder cattle index looks like. So this is off of the CME website. You can actually go out there and see this every day. The feeder cattle index is a 12-state index that the CME pulls together daily. The 12 states are Texas, Montana, Missouri, Nebraska, Colorado, Oklahoma, Kansas, New Mexico, South Dakota, Iowa, Wyoming. I think that's pretty close to 12. And so it's all those kind of middle states where all the feeder cattle are at. And so all those sell barns in that area, the bigger ones that the CME collects data from, they report their prices daily after sales. And that's what constructs the CME Feeder Cattle Index. Here's kind of what the index has done last year compared to a 5-year average between 16 and 2020. You see there, over 5 years, the cash index stays pretty flat, and there tends to be that convergence between futures and cash that always happens as those contracts expire. But 2020, I have it segregated out there just as a 1 year, just to kind of show the gyrations we went through in 2020 in the feeder cattle, the cash market there. And then so far in 2021, we're only into February, but it's that darker blue line, if you can see that. That's kind of been ebbing and flowing here. We definitely had some ups and downs early on in 2021. The Fed Cattle Index, like I said, it's an AMS report, which is the Agricultural Marketing Service. They pull this report together every Monday and release it out. The feedlots that report to it, it's a 5-area. And so the 5 areas are, one of them is Texas, Oklahoma, New Mexico as one area. Kansas is considered on its own. So is Nebraska. And then so is Colorado. And then the Iowa and Minnesota feedlots. And then I believe on the earlier slide, I said which category they use. So they use that the steers, live, the 35 to 65% choice category. So if you had it, so this report was released on October the 19th of 2020. So if you had one for the week that ended on 10/18 or any of those days prior, if an endorsement had ended on any of those dates prior, the ending value they would have used would have been the 108.10. And that would have been the ending value RMA would have put out to settle any endorsements against. And then gathering those reports over the past year, probably 13 months, you kind of see what the fat cattle, what this at least report has done over time over the past year or so. And it's definitely had some up and down movement in it as well. So if you write one of these policies, and hopefully if you were to have Erin as your agent, Erin wrote it with Hudson as the carrier. What could you expect in a loss situation? Well, you have your endorsement end date, and that's a specified date that coverage ends. 3 to 5 business days or so after that end date, the RMA will release the ending value. We will generate any claim documents or non-loss letters if it was a non-loss situation, and we would send those out to you as the producer, also to your agent, so they are aware of that the coverage is ended, and can help facilitate the movement of those records back to, and those claim documents back to Hudson for processing. If there's a loss, then the faster you get them back to us, then the faster we can get you a claim check right back out. Like Erin said, there is no loss adjustment activity in it. We do request supporting documentation. So if you have sales receipts or packer receipts or something like that, that helps support in case RMA ever were to do a review or anything. And the policy does state that as a producer, you are required to retain your receipts for up to 3 years after the end of the endorsement period. But just providing those records just helps support that claim. And we just keep them on your file, in your electronic file in our system. But the agent can help facilitate the movement of those documentations through. But since it's just a price product, whatever that ending value comes out, that it is what it is. And then whatever you set your floor at, that coverage price, it's just going to indemnify you on that difference. And then once you have your documentation in, then we turn around and process the claim. And if there's a loss there, then we send out a check. If there's no loss, then once we send you that non-loss letter, then the coverage is ended, and it's pretty much done with at that point in time. Like Erin said, starting with the reinsurance year the crop year 2021 back on July 1st, the RMA changed the rules where you used to have to pay your premium up front when you bought the endorsement. That is now billable at the end, and it will be offset from any indemnity that you have due. So if you have a loss and you're expecting, money back out of it, then we'll put those loss credits towards your premium first. If there's anything left over, then we cut that check. If there isn't anything left over and you actually still owe, then we'll still send you that bill for whatever that difference is between the premium and the and that loss amount. Some other things just to kind of keep in mind with LRP, there are price adjustment factors that are built into the policy. So when we have those expected ending values, that's already been taken into account. So based on the board, since it's just feeder cattle, based on the weight class and the types, they all have kind of different price adjustment factors, if you will. So if you were to try to insure a lightweight steer and the board came in at 150, they're going to multiply that by 110% to set that lightweight steer's expected ending value. If it's a heavier weight steer, the 600 to 900, as you can see, there is a price adjustment factor, but it's just 100%. So it's just multiplied by 1 at that point, and that's how they determine your expected ending value. If it's unborn, all the steers and heifers, it's 105%. And then as you go down the chart there, unborn, the predominantly Brahma, they get 100% as in the lighter weight class, 90% in the heavier. If they are marketed as dairy, and all these, the Brahma and the dairy, it's what are they marketed as? If they're marketed as just beef cattle, then they would just be insured as the steers and heifers. But if they are marketed as dairy or Holsteins or anything like that, then we would want to insure them that way. And so here on the dairy, their price adjustment is 50%. So they get knocked half of whatever the board was doing for their price adjustment factors. And that's done on setting the expected ending value. And then that same calculation is done on the back end when we're figuring that actual ending value. So it's equal on both sides of the equation. So kind of to look at a comparison of what that might look like. Steers, if it had an expected ending value of 126.77, you would look at heifers that would be sitting somewhere at 114.09. This is for heavyweight, so you would take and minus it by 10% because heifers got a 10% reduction, if you will. And then since we have coverage levels that are then built off of that, at 99% coverage, you see what your coverage price is and how they differ between the steers and the heifers. The rating, however, is the same. They are all built off the same actuarial tables. And then that cost per hundredweight, since we have different coverage prices, we have a different cost per 100 pounds. And these are both similar endorsements that ended on the same date, that ended back in January of 2021. Hudson does have a public quoter. If I have some time, and Garth just lock me down if I start going over, but we do have a quoter that if we have time, I'd like to show it. It's out there publicly on our Hudson Crop website. You could go out there and kind of run some test scenarios. If you have one in mind where you're like, well, I got 25 fats out there that I'm feeding out right now, what would it cost me to insure them on today's prices if I know I'm ready to market them in 4 to 5 months or something like that. And so I can definitely show you that. It's public. You don't have to have a login or sign up or anything like that. It's a public quoter. The endorsement, this is just that form that you would have that actually binds coverage and provides the actual coverage, the liability that has that specific end date when coverage ends. Next up, I'm going to open it up to questions. Anybody have anything?
Thank you, Justin and Erin. Anybody have any questions? Feel free to type them into the chat or the question and answer box. While they're thinking up some potential questions, we've got a few minutes if you want to demo that quote tool.
Yeah, absolutely. So I'm going to drag my web browser over here, guys. Just bear with me. So just any web browser, hudsoncrop.com, you'll be taken to our home page. When you hover over the products, the drop down will be brought up, and then LRP under livestock is the bottom one right here. When you select that, you'll be brought to our LRP main page. There's some really useful things on here. We talk about what was new for 2021, a breakdown of the different commodities that are insurable. As you can see, we kind of have updated it with the different endorsement links and subsidies, and there's a sales calendar down at the bottom. But the quoter's over here on the quick link side, so LRP quoter, and if we were to click that, it's going to take you right into our quoting tool, and you don't have to be logged in or anything. It'll take you right here. So our reinsurance year, you heard me call it crop year a lot. They're interchangeable with livestock because they're one and the same. So we're in the 2021 crop year. We're looking at today's effective date. So for 2/24, since the board's closed for the day, we were to look at Ohio prices, which since it's a national index, guys, the state really doesn't matter, but just being respectful. So use your state. Commodity, if we were to look at fats, our top is going to auto select to steers and heifers since they are all in one group. And it's going to bring up every applicable offer that the RMA put out there for today. There were 87 offers that were put out. That's different coverage levels, different endorsement links, different premiums. Now we want to run a scenario per head. So what if we were to do that one we had in the example at 50 head at 1,300 pounds at 100% share? And we want to calculate over here. And now it's going to break it down, and it's going to sort them in the endorsement link. So it's going to start with the shortest one first, so 13 weeks or 3 months. It gives us an end date of the end of May 5/26. Now on this one, the expected value that's based off of the live cattle contract, but it's not the exact number, is 120.47. It starts at the lowest coverage level, and if we can go down, then we can go up. But at this one, it's 86.63% coverage level, so we would lock in a price floor of 104.37. And how much would that cost? So we come over here at total premium. That would cost $369. Subsidized a subsidy of $166. So producer premium comes out to be $203. And then we break it down to you for a cost per hundredweight or a cost per head. Most producers want to look at those higher coverage levels. So if we go down the 13 weeks here and go to the bottom one, that's going to be the highest coverage level they offered for today. So that's actually pretty close to 100%, 99.91%. So out of an expected ending value of 120.47, they're going to lock you in coverage at 120.37. It does get a little more expensive the higher the coverage level goes. So the total premium there is $3,067. With that subsidy, which remember in 2021, it's now 35% at that higher level, subsidy is $1,073. So we have total premium, producer premium of $1,994. Break that down. It's right around $40 a head, $39.88 or $3.07 per hundredweight, or once again, a little less than 4 cents per pound.
Justin, I want to draw attention because this is all that you're showing here on these lines is exactly what your agent would need to fill out that specific coverage endorsement.
Absolutely. Yep, absolutely. Yeah. So since this is out there on public, like I said, if you go to the Hudson Crop website, you can go there and play with this scenario. You can print the estimates out if you wanted to. When you hit cancel, it'll bring you back to your scenario. If you wanted to play around then with the feeders, so you could do feeder cattle. There we have all the different types. If you remember, so we have steers, we have heifers, Brahma, dairy, and then the unborns. So we were just look something like steers weight 2s. If we did the same, 50 head, if we did 8.5 or 850 pounds times 100% share, and we can calculate that out. And then we can start looking at what is some of those endorsement looks like. I can tell you, so they have an expected value for May of 146.80. If we go to the board, the feeder cattle contract in May, it's settled at 146.80. So it's very reflective, like I said, of what the board is doing when they come out with these expected ending values. Not every day will it be down to the penny, but it always is fairly close. And it's based off of that. So just know that it's never going to be probably exactly like this all the time, but it's based off of that. And then once again, they did put out a 99.46% coverage, which locked you in a coverage price of 146 on a feeder steer. Cost you about $26.64 per head.
All right. Certainly appreciate going through what that fed cattle scenario looked like during COVID, and maybe the value of risk protection should we find ourselves in crisis mode, for lack of a better word.
Absolutely. So I believe I'm out of time, Garth. So I guess I'd summarize it in, if anybody wants to know about that other product, the LGM, they can shoot us questions, shoot Erin questions, and we can always discuss it later.
Shoot my slide up there real quick, Justin.
Absolutely.
That way they jot down my contact information. So I am, again, here in Ohio. I'm located in Ansonia, which is Darke County, but cover all of Ohio and Indiana as my license. So you can see my office number, my cell phone, email, website, and our social media accounts.
Well, thanks to the both of you. Certainly appreciate you taking the time to share this with Ohio producers. And I'm sure if there's any questions in the future, we'll direct them to get a hold of Erin, if that works.
Thank you so much.